right, here we are again. We just spent a few minutes with the folks in here going over the results of the test. Everybody here did really good. So this will probably be not a full 50-minute class for you folks at home. It'll probably be about 35 or 40 minutes, but that's okay. We should be able to get through what we want to get through today. Okay? But we wanted to spend a bit of time talking about the test. Remember the ability to drop your lowest score of the test if you didn't do as well as you wanted. So that can really help. You cannot drop the final, though. The final exam is comprehensive. You cannot drop the final for folks at home or for folks here. Okay? Now, we do, and as I said this many times, I spend more time in chapters 1 and 2 than most teachers. So there will not be as much time between now and your test over chapters 3 and 4 as there was from the beginning of the class to the first test. Okay? So don't think we're going to have another 5 weeks before the test, because it won't be that long. It won't be near that long. Okay? Plus, chapter 4 is really short. Okay? So, but I'll always give you a notice on your test, and for you folks at home, watch your emails, as always, for information about your tests. All right? Okay, let's jump back into chapter 3. Let's just do a quick little review, a little bit going to the PowerPoints. We talked about, going back a slide or two, how we use the accrual basis of accounting. That means we recognize revenues when they are earned. When are they earned? When we provided the product or service, not necessarily when cash comes in. And we recognize expenses when they are incurred. We do not use the cash basis, which triggers everything from when cash is coming in or going out. Now, to follow this, we talked about the matching principle. The matching principle states that we want to match the expenses to the periods in which they helped create revenue. Okay? And then we talked about what is an AJE, or an adjusting journal entry. That's just a type of journal entry that's going to do two things. It's going to bring an asset or liability account to its proper balance, and it'll also recognize a revenue or expense in the period it should properly be recognized under the accrual method. Okay? We talked about how you make AJEs on the last day of the period. Some people do AJEs every month because they do financial statements every month. Some people just do financial statements at the end of the year, and so they only do AJEs at the end of the year. And cash is never part of an AJE, the cash account. Okay? We talked about how there's 5 types, and I believe these are the first 2 types that we have gone through. Is that correct? Is that right? Okay, what I want to do now before we go on to the next types is I think I gave just 2 quick studies to do. Is that correct? So let's go through that homework. That was quick study, was it 3.4 and 3.5? All right, let's go through that. Hopefully you guys did that. Once again, the way you learn AJEs is not by watching me do them, but to do them yourselves, okay? Okay, quick study 3.4, page 115 in your book. A, on July 1 of 2009, Rendex Company paid $3,000 for 6 months of insurance coverage. No adjustments have been made to the prepaid insurance account, and now it is December 31 of 2009. Okay, so what we did on July 1st is we debited prepaid insurance, which is an asset, correct? And we credited cash. That wasn't the AJE, that was just the journal entry when we bought this insurance. It's now December 31 of 2009. Prepare the journal entry to reflect expiration of the insurance as of December 31 of 2009. Now it tells us no adjustments have been made, right? Okay? So what is the AJE that we would make at December 31? Well, let's take a look. How much of that prepaid insurance has been used up. Actually, all of it, hasn't it? Okay? All right, let me find this. Let me back up a little bit. Okay, so the AJE that we make is shown on the screen, okay? We decrease or credit prepaid insurance, and we debit insurance expense. Now, did anybody do the following? Did anybody make 6 different AJEs, one at the end of July, or one at the end of, let's see, one at the end of July, August, September, October, November, December, each one for 500? Because some, you made one and said, okay, yes, the wording in this textbook's not real good on this. Some students misunderstood, and understandably what they did is they did a journal entry, the same debit, the same credit for $500, and they said this is the AJE that needs to be made at the end of each month, okay? And while that's technically not correct what they were asking for, it does show me that you're understanding what we're doing here, okay? If on a test or something, if you're ever confused, just come up and ask me here if you're live. Or for you folks at home, if you are ever taking a test and you wish I was there to ask a question to, just write me a note and say, this is the assumption I made. I made the assumption that you wanted me to do an AJE at the end of the year or just at the end of each month or whatever assumption you're going off of, and I'll look at those, okay? All right, any questions on this AJE right here? Not too bad. Okay. Let's take a look at the next one. Quick Study 3.4b. Indus Company has a supplies account balance of $900 on January 1 of 09. During 09, it purchases 4,000 of supplies. As of December 31, 09, a supplies inventory shows 750 of supplies available. Prepare the AJE to correctly report the balance of the supplies account and the supplies expense account as of December 31 of 09. Okay, so let's take a look at this. I think what we need to do here, or what we can do, is to do a T account. Okay? Supplies is an asset, right? So it is a debit balance account, right? It tells us that the beginning balance of supplies is 900. So that would go right here, correct? It also says during 09 it purchased 4,000 of supplies. So that would go right here. Okay? We debit supplies and probably credited cash or AP when we purchased those. So that would go there. Now we take a count at the end, we take an inventory count, and how much do we have left? So our ending balance is 750. So this will be the amount that was used up, correct? So there's one amount and only one amount that goes in that circle that properly shows the amount that was used up, correct? And what is that amount? 4150. Once again, does that plus that minus that equal that? Yes, it does. Yes, it does. Okay? So the AJE would be right there at the top. Okay? Questions on that? Okay. Good. Good. Okay, let's go to Quick Study 3.5. Andrews Company purchases 45,000 of equipment on January 1 of 09. The equipment is expected to last 5 years and be worth $3,000 at the end of that time. So that $3,000 is called the residual value again, or the salvage value. Prepare the entry to record 1 year's depreciation expense of $8,400 for the equipment as of December 31 of 09. Now they figured this out for us. They didn't really need to, did they? Let's go ahead and check them. Make sure they did it right. we know to figure out depreciation expense, that equals the cost minus the salvage value over the estimated life, right? And these amounts that they gave us were $45,000, salvage value of $3,000, divided by 5 years. Okay. Somebody bang that out on their calculator. Does that in fact equal 8,400? It does? Okay. So that's how they got that amount. Okay. So our journal entry, our adjusting journal entry is this. Okay. Let me back that up a little bit. Okay. So our journal entry, adjusting journal entry, to record depreciation, debit depreciation expense, credit accumulated depreciation. Okay? All right? Any questions on that one? Okay, now I want to talk about something real quick in regards to that, but let's look at B real quick. Fortel Company purchases $40,000 of land on January 1 of 2009. The land is expected to last indefinitely. What depreciation adjustment, if any, should be made? We don't depreciate land, do we? So there's no journal entry. There's no AJE. We do not depreciate land. Okay? They're trying to trick us. Okay. Let's go back to Quick Study 3.5a. I want to answer the question, and I think I asked you to think about this, and I'm sure you did a lot of time with I'm sure you didn't watch football, but you thought about this question. Why do we use an accumulated depreciation account? Why don't we just, in Quick Study 3.5a, why don't we debit depreciation expense, and why don't we just credit equipment itself? Okay. True. True. Okay. You're close. You're close. You're in the right ballpark there. Okay. Let me talk about why we use accumulated depreciation. Why we use that. And what type of account is that, guys? What type of account is accumulated depreciation? Bum, bum, bum. It's a credit balance. It is a contra asset. Remember? Remember contra? What does contra mean? The other side. Not this, but that. Right? Not this, but that. Okay? So an asset is a debit balance account. A contra asset is not a debit, but a credit balance account. Correct? Let me also remind you this. The way that this looks in the balance sheet is you have a cost of an asset minus the accumulated depreciation, the contra asset, and that equals the book value of the asset. Okay? Now, I will tell you, you depreciate an asset, you depreciate it down until the book value equals the salvage value that you estimated. Do you see this? Okay. Now let me tell you though, in real life, most of the time people don't estimate salvage values or residual values. Most of the time, you know what they use for their estimate of salvage value or residual value? 0. Okay. They just say salvage value 0. When I would go in and audit companies, that's usually what they would estimate. So in that case, if you have a truck that you paid $20,000 for and it's going to last you 4 years, you depreciate $5,000 per year, and then it eventually has a book value of 0. Are you with me? Now, the reason we use an accumulated depreciation account is because of the following, and it's what you were talking about, Zach. The way that this would look on the balance sheet, let's say you have that truck for $20,000 that you paid. You estimated a salvage value of 0 and a useful life of 4 years. You depreciated $5,000 for each year. You're now into the 5th and 6th year, which is longer than your estimated life, right? Do you get rid of the truck because you say, well, I only estimated it the last 4 years, so I can't use it? No, of course you keep using it. How is that going to look on the balance sheet once that truck is fully depreciated? It's going to look like this. What's the book value? 0. Okay? Once again, is the purpose of depreciation our attempts to match the market value of the fixed asset? No. Okay? You are sitting in the library building here on campus, right? This is an old building for JCCC. I think it's one of the first ones. Now, this building is probably fully depreciated. Let's say it cost, I have no idea, let's say it cost $20 million to make back when they made it. It's fully depreciated. If you looked at the balance sheet of JCCC, and they have one, it would say library building, $20 million, less accumulated depreciation of library building, $20 million. The book value of this building is thus what? 0. Does that mean the market value is 0? Could you go find Dr. Calloway and the Board of Trustees and offer him $5 for this building and they jump at it, saying, well, that's $5 more than market value? No. Accumulated, or the purpose of depreciation is not our attempts to try to match what the market value is, because that's very subjective anyways. Okay? The purpose is to spread the expense out to a reasonable amount of periods, to match that expense to the periods in which that fixed asset helped to create revenues. Does that make sense? So again, to this question, why do we use an accumulated depreciation account? Well, if we instead of using an accumulated depreciation account in our depreciation entry, if we just credited the asset itself, then what we would have, and this is the cost of the truck, right? This is what we would have on our books. Truck, 0, once it's fully depreciated. Now, wouldn't you agree that even though both of these situations have a book value of 0, don't you feel that that gives the reader more information as far as that truck than if you just did this? Do you see what I'm saying? Like you said, Zach, we still have the asset, don't we? It's just fully depreciated. Does that mean it's worthless? Quite the contrary. I drive an old car. If this were a business car, it would be fully depreciated. But that car gets me to work every day, doesn't it? It's not worthless to me. Okay? So does that make sense? Does that give you a little idea of kind of why we use the accumulated depreciation contra asset for fixed assets? Yes. Okay? All right, good. Let's go on to the third category. We talked about these two. Let's go to the third category of AJEs. Okay? And that is in regards to unearned revenue. Now, what type of account is unearned revenue? It is a liability. We talked about this. If you gave me money for a service that I have not yet performed, I cannot record that as revenue because I have not yet provided that product or service. I have to record that as a liability, unearned revenue. As I provide that product or service, the third AJE involves decreasing unearned revenue liability and booking it as revenue. Okay? Let's take a look at an example. All right. Let's go forward to the third category. Okay, on October 1 of 07, Ox University sold 1,000 season tickets to its 20 home basketball games for $100 each. Now, they made the following entry on October 1 of 07. This is not the AJE. We know that because cash is involved and it's not the last day of the period. But when they got that money from its fans, they got a total of $100,000 cash, but they booked that not as revenue but as unearned revenue. Why did they book that as unearned revenue liability? What service have they not yet provided? The actual games themselves. They have not provided the actual games themselves. So that's for 20 home basketball games, the $100,000 is. On December 31, they have played 10 of those 20 regular home games. Okay? So how much of that $100,000 revenue have they earned? Well, let me ask you this. How many of the games, what percentage of those games has been played? 50%. Thus, how much of that unearned revenue has been earned? 50%. What's 50% of 100,000? 50,000. So the AJE is thus a debit to unearned revenue, which we know is decreasing unearned revenue since it's a liability with a credit balance. And we can book $50,000 worth of revenue. Understand? Okay? This does two things. It lists the liability at the proper amount, which is $50,000, and it books that $50,000 of revenue in the proper period. Okay? Remember that example I gave from last period, that REAL? Does this follow that rule? Is there liability that's affected? Yes. And then the other side has to be an expense or revenue, and it is a revenue in this case. You with me? Okay, what I want to do now is, in class, and for you folks at home, do it as well, let's go ahead and do Quick Study 3.7. Quick Study 3.7. Let's take a few minutes to do Quick Study 3.7. let's go over those answers. Let's go over those answers for Quick Study 3.7. Okay? Fortune Company receives $30,000 cash in advance for 4 months of legal services on October 1 of 09 and records it by debiting cash and crediting unearned revenue, both for $30,000. It's now December 31 of 09 and Fortune has provided legal services as planned. Now let's see, they got it on October 1, so that's October 1, November, and December. October, November, December. That's 3 months, and it was payment for how many? 4? So how much of that $30,000 have they now earned? 3/4 of it. What is 3/4 of 30,000? 22.5? Okay. So the AJE is as follows. Okay. There is your answer. Okay. We decrease or debit unearned revenue, and we credit revenue. You could call it legal revenue if you wanted. If you just called it revenue, that's okay as well. Did you guys get that? Okay, let's do Quick Study 3.7b. Warner Company started a new publication called Contest News. Its subscribers pay $24 to receive 12 issues. With every new subscriber, they debit cash and credit unearned subscription revenue for the amounts received because they have not yet provided the magazine, right? The company has 100 new subscribers as of July 1 of 09. It sends contest news to each of these subscribers every month from July through December. Assuming no changes in subscribers, prepare the AJE that they must make at December 31, 09 to adjust the subscriptions revenue account and the unearned subscription revenue account. Okay, they had 24 it's $24 for subscription, and they had 100 new subscribers, right? So they originally debited cash and credited unearned subscription revenue for $2,400, right? And that's for how many issues? 12? How many of those issues percentage-wise have they sent out by December 31? Half of them are 50%. So they can book $1,200 of earned subscription revenue, and they can decrease the unearned subscription revenue. Okay? For the 6 issues that they have sent out. Does this make sense? Okay? Any questions on that? Okay, if not, then let's talk about the last 2 categories of AJEs. Okay? The last 2 categories, well, the 4th category is, let's see, how come this won't go down? There we go. Okay, I thought we had an emergency there. Is something that we called accrued expenses. Accrued expenses. Now with these last 2 categories of AJEs, the cash flow, whether it's an inflow or an outflow, will occur after we book the expense or the revenue. Let's take a look at an example. Barton Inc. pays its employees every Friday. However, year-end, 12/31/07, this year falls on a Wednesday. So as of December 31/07, that Wednesday, the employees that we have earned salaries of $47,250 for Monday, Tuesday, Wednesday work. So do we owe our employees money as of 12/31/07 end of the day? We're not going to pay them that day, are we? But we need to show the liability on the books. We're still not going to pay them until Friday, 1/02/08. But we have to make the following AJE to do 2 things. To show the liability of salaries payable, what we owe them at 12/31/07, and to book that expense into the proper period. Okay? We have to do those things. All right. Now, for a large company, this could be a pretty big accrual, could it not? Think about somebody like Sprint or Hallmark. This could be hundreds of thousands of dollars, millions of dollars, right? So that is an example of an accrued expense. Another example of an accrued expense might be you come to the end of your accounting period and there's interest that you owe on some sort of debt instrument. You don't have to pay it that day, but you do need to show that you have a liability of some interest that you owe. And in that case, you would debit interest expense and you would credit interest payable. That's another type of accrued expense. I think you have one of those in your homework. Okay? Fifth and final category is in regards to accrued revenues. Let's look at an example. Smith & Jones CPAs had 31,200 of work completed, but we haven't even billed our clients. We need to make an AJE on December 31 of 2007 to record those accrued revenues. Now, we have earned these revenues, right? We've earned these revenues because we've provided the work. We've completed the work. We're not going to get paid for a while, but we still need to show the following AJE. We need to debit a receivable, an asset, and we need to credit a revenue and book that revenue. This shows the proper asset on the books, and it books the revenue in the proper period in which it was earned. Okay? Which is 07. Make sense? Another example of an accrued revenue might be, let's say you have some sort of investment, some sort of asset, and you are owed interest. They owe you interest. Now, they're not going to pay you at the end of this period, but you want to show that you have some interest receivable, that somebody's going to pay you. You want to show the amount that is due at the end of that period. Even if what they pay you later on is a larger amount, don't book that part. Just what they owe you at that time. And in that situation, the AJE would be debiting an interest receivable and crediting interest revenue. Okay, that's another example of accrued revenue. You with me? Okay, now when I give you guys your homework, the first time you do AJEs, you're always kind of like, I don't get this. What's going on? Don't just shut the book and give up. Okay, try to work through it. You paid a lot of money for this crazy textbook. Read the textbook. Read what it says. Okay? Because the second time you do AJEs, it's going to be a lot easier. Third time, it'll be a lot easier. And after you do it a number of times, you'll say, I got it. Okay? The problem is for those who don't do homework, when's the first time they actually do AJEs? The test. And then how do they do? Stinky pooey, right? Okay? So, do your homework. Don't just close the book and go, I don't get it. Krug will explain it. Okay? You folks at home, have the discipline to be doing your homework. You're not going to learn anything just by watching me. Okay? All right, the homework, there's just 2 of them, but I want to make sure you do both of them. Exercise 3.2 and exercise 3.5. All righty? Do that, work hard on it, and we will go over it next time. See you later.